The twofold effect of accounting basically means that every transaction that the business undertakes has at least a twofold effect on the balance sheet. And what that means is at least two items must be affected for every transaction. So that means at least one or two out of the following must go up or down as a result of a transaction. So we've got assets, liabilities, owner's equity, revenues, which will increase owner's equity, and expenses, which will decrease owner's equity. So this means the accounting equation, which we know as assets equals liabilities plus owner's equity, we can tack on a little bit at the end, which is revenues less expenses. By that we mean that any revenue will make owner's equity go up and any expense will make owner's equity go down. So the best way to demonstrate this is to use what's called a worksheet, and we're going to use the accounting equation in table form to process each of these transactions. So each transaction has a twofold effect, which means at least two things must be affected in the table below. So the first transaction is the owner deposited 80,000 capital to commence the business. So the cash at bank goes up 80,000 and so does capital. Looking at our accounting equation, assets up 80, no impact on liabilities, owner's equity up 80. From that information, we'll now make a balance sheet. We're not going to classify this balance sheet, we're just going to keep it simple. Cash at bank goes up 80. Capital goes up 80 on the other side, and our balance sheet balances. The second transaction is the business took out a loan for $20,000, so at least two effects must happen in the balance sheet. First one is cash has gone up 20,000, but subsequently we have a loan that we owe the bank for 20,000. So accounting equations standpoint, assets up 20, liabilities up 20, no impact on owner's equity. There's our old balance sheet. What we'll need to do is update that. So we'll need to update the cash figure from $80,000 to 100. And then the old balance sheet didn't have any liabilities. So what we'll do now is add in the loan for 20,000, redo our totals, and we'll have a total of $100,000 for each side of the balance sheet. The next transaction, the firm bought shop fittings for cash, $10,000 plus GST of 1,000. Business has a new asset called shop fittings of 10,000, so that increases. We've paid GST, so we learned during the GST units that we will decrease our liability by 1,000. The other impact here is that the firm now has $11,000 less cash. Looking at the accounting equation, we've got one asset going down 11 but up 10, so that's a balance of negative 1,000. Liabilities will be negative 1,000 and no impact on owner's equity. There's the old balance sheet. We can see cash is 100,000. We'll need to change that to 89,000. We didn't have shop fittings in the old balance sheet, so we'll add those in. And the GST liability, we're at the point where actually the government will owe us money. So at this point, we're actually going to put that under the assets section as a GST refund. Retotaling the balance sheet, the totals will actually be the same. The last transaction in this set is we bought stock on credit for $15,000 plus GST of $1,500. So I now have an asset called stock increasing $1,500. I've been charged $1,500 GST, so the government will give me that money back. It reduces my liability. And this time, instead of cash at bank going down, creditors will increase $16,500. So we have assets increasing 15,000, liabilities increasing 15,000, and no impact on owner's equity. Looking at the old balance sheet, we didn't have any stock, so we'll need to add that in. GST liability, well at the moment we actually have a refund of 1,000 and the government will actually give us the other $1,500 back. So we'll actually get $2,500 back from the government. So that would be a GST refund under assets. And lastly, the old balance sheet didn't have anything for creditors, so we'll put creditors in as a liability. Retotaling the balance sheet, we'll see that both sides will equal $116,500.